There's a pattern that has destroyed economies not from the outside, but from within. Not from a stock market crash, not from a housing bubble, but from a silent and relentless buildup of debt. And when the dam finally breaks, it happens in a predictable and devastating sequence. The United States, the largest consumer economy in world history, just passed a chilling milestone: $1.2 trillion in credit card debt, the highest level ever recorded. This isn't just a number, it's a ticking time bomb wired directly into the heart of the American economy. For decades, the engine of US growth has been fueled by consumer spending, and that spending has been increasingly powered by plastic. But now, that engine is redlining. This is the story of how that debt bomb could detonate, not in a single explosion, but in a series of cascading failures, one domino falling after another. How a crisis that starts at the kitchen table with a credit card bill spirals into a national economic catastrophe, and why every warning sign says the first domino is already starting to wobble. Let's start with the sheer scale of the problem, a scale that is difficult to comprehend. For the first time in history, Americans collectively owe over $1.2 trillion on their credit cards. This isn't some abstract government figure. It's a burden carried by millions of families. The average American household is now wrestling with over $8,000 in high-interest credit card debt. And these aren't the low introductory rates of the past. The average interest rate on this debt has skyrocketed to over 22%. To put that into perspective, that's a higher interest rate than what was once considered predatory lending. It means that for every dollar of debt, families are being charged an extra 22 cents every single year, compounding relentlessly. This isn't just about financing a new television or a vacation. For a growing number of people, credit cards have become a desperate lifeline used to pay for groceries, gas, and utilities as wages fail to keep up with the persistent sting of inflation. They are borrowing money at exorbitant rates simply to survive, digging a hole that becomes exponentially deeper each month. When you look at the math, you realize the situation isn't just bad, it's fundamentally unsustainable. The system itself is designed to trap people. With over $1 trillion in debt at an average of 22% interest, Americans are now collectively paying more than $130 billion per year just in interest and fees. Think about that. That's $130 billion that produces nothing, builds no equity, and buys no goods. It's a direct transfer of wealth from struggling households to the balance sheets of financial institutions, a tribute paid simply for the privilege of being in debt. For an individual family holding that average $8,000 balance, they are paying nearly $1,100 a year just in interest. For many, the minimum payments they are required to make barely cover that interest, meaning the principal balance, the actual amount they borrowed, hardly budges. They are running on a financial treadmill, working harder and harder just to stay in the same place, while the bank's profits swell. This isn't an accident. It's the core business model. But a system that relies on extracting ever-increasing sums from a population that is already stretched to its limit has a mathematical breaking point. We are now dangerously close to finding it. The first domino to fall is already in motion. Defaults are spiking. For months, the financial world has watched the delinquency numbers with growing anxiety. These are the people who are 30, 60, or 90 days late on their payments, the canaries in the coal mine. As of early 2024, the rate of serious credit card delinquencies has surged past 3% and is still climbing, hitting levels we haven't seen since the aftermath of the great financial crisis. More telling are the charge-off rates, which is when a bank gives up on collecting a debt and writes it off as a loss. Those rates are also spiking, reaching their highest point since 2010. This isn't a statistical blip, it's the sound of the foundation cracking. It signals that a significant and growing portion of the American public has hit a wall. They've exhausted their savings, they can't cut their spending any further, and they are now being forced to make an impossible choice: pay the credit card company or pay for rent and food. When millions of people start making that choice at the same time, it's the first tremor of a much larger earthquake. The first domino isn't just wobbling, it has begun its inexorable fall. The second domino follows almost immediately. Consumer spending crashes. The American economy is a unique beast. A staggering 70% of its entire gross domestic product, GDP, is driven by consumer spending. What you, your neighbors, and everyone else buys is what keeps the entire system running. For years, when wages were stagnant, that spending was propped up by cheap and easy credit. But what happens when the credit cards are maxed out and the lines of credit are cut off? The engine seizes. The spending stops, and it stops fast. This isn't a gradual slowdown. It's a sudden, brutal stop. People who were using credit to bridge the gap no longer have that option. Retail sales, which are already showing signs of weakness, would plummet. Orders to factories would be cancelled. Shipments would halt. The entire logistics and supply chain, from the container ships on the ocean to the delivery trucks in your neighborhood, would grind to a halt because the final link in the chain, the consumer with a valid credit card, has been broken. This is the moment the abstract numbers on a bank's ledger become empty shelves and going out of business. Signs on Main Street. The collapse in spending would be the second, much larger domino, and its impact would be immediate and devastating. The third domino is when the crisis ricochets back to its source. The banks start taking massive systemic losses. That $1.2 trillion in credit card debt isn't just a liability for consumers, it's an asset on the balance sheets of the banks that issued it. They count on the interest payments from that debt as a primary source of profit. But when defaults rise, those assets turn toxic. If default rates were to climb to the levels seen during the 2008 financial crisis, a scenario that is looking increasingly plausible, banks would be facing over $200 billion in write-offs from credit card losses alone. The mega banks like JP Morgan Chase and Bank of America might be able to absorb such a blow, but the pain would be acute. The real danger, however, lies with the hundreds of smaller regional and community banks across the country. These institutions are far more exposed. They don't have the diversified revenue streams of the Wall Street giants. For many of them, consumer lending is their bread and butter. A wave of credit card defaults, happening at the same time as potential losses in commercial real estate, could be an extinction-level event, triggering a series of bank failures reminiscent of 2023, but on a much wider scale. This is the third domino, and it transforms a consumer debt problem into a full-blown banking crisis. The fourth domino is the inevitable and panicked reaction from the financial system. A total credit freeze. As banks hemorrhage money from defaults, they will do what any institution does when it's fighting for survival. They will slam the brakes on lending. The first to go will be any new credit card offers. Then, existing credit limits will be slashed, even for customers who have been paying on time. The goal is to reduce exposure at all costs. But the impact spreads far beyond just credit cards. Credit scores across the nation will crater as millions of people fall behind on payments. A bad credit score is a financial black mark, and it will lock an entire generation out of the economy. Mortgages will become impossible to get, as banks refuse to take on the risk. The housing market, already fragile, would enter a deep freeze. Car loans will dry up, crippling the auto industry. Small business loans, the lifeblood of entrepreneurship, will disappear. The flow of credit is the economy's circulatory system. When it stops, every part of the body begins to die. This fourth domino represents a systemic seizure, where the mechanisms of economic life simply stop functioning for ordinary people. This sets the stage for the final break, the point of no return where the crisis feeds on itself in a vicious death spiral. As consumer spending evaporates and credit freezes, companies are hit with a catastrophic drop in revenue. Their first and only move to survive is to cut costs, and that means laying off workers. Unemployment begins to rise, slowly at first, and then with terrifying speed. But every newly unemployed person is also a new person who is about to default on their credit card, their car loan, and their mortgage. This creates even more losses for the banks, which in turn restrict credit even further, which causes more companies to fail, which leads to more layoffs. This is the feedback loop from hell. And what can the Federal Reserve do? Its tools are useless here. If it cuts interest rates to try and stimulate the economy, it risks reigniting inflation and devaluing the dollar. If it raises rates or keeps them high to fight inflation, it accelerates the defaults and bankruptcies, pushing the banks closer to the edge. They are trapped. There are no good options left. This isn't just a recession, it's a systemic breakdown, triggered by the simple, predictable failure of a system built on an impossible mountain of debt. We are following this exact pattern, step by step, warning sign by warning sign. The only question is whether we're near the beginning, the middle, or the end.